We're counting down to next Wednesday's Fed decision as stocks head for a mostly positive monthly close. How will the critical rate decision impact the market and recession odds? Let's bring in Ed Clissold, Chief U.S. Strategist at Ned Davis Research, and Jeff DeGraaf, Renaissance Macro Research Chairman. Good to see you both. Jeff, just in terms of the market setup here and as it relates to expectations for where we are in this economic cycle, a lot of credit being given to the market for kind of hanging in there and a lot of criticism of the market for how it's doing it, which is with only a handful of stocks. What's your read on that?
Yeah, I think breadth is being overplayed. That can catch up very, very quickly. Breadth was pretty good up until Silicon Valley Bank, and then it did fall apart. It hasn't made a new low, but I think that's a technicality. It's pretty close to doing so. Most of the weakness that we see in small cap, I think you can look at from a sector differential, right? There's about twice the weighting in small cap names as there are on large cap names for banks. So, I just got back from London last night, actually, and it was certainly a topic and an area of concern with clients. But I think the other thing to just keep in mind is how much better the global indices look than the U.S. indice. And if you gave me a choice between stronger global indices and weaker breadth domestically, or vice versa, I'd take the former. I think the breadth that we're seeing globally is more important about the economic outlook, about really the health of the market, than what we're seeing from, I think what can be characterized as probably some concerns around the banking system, but other than that, pretty contained.
That's a good point. And Ed, I know you've been doing a lot of work on what is an admittedly ambiguous picture of where we are in terms of this market being a new bull market, being still kind of stuck in the bear phase, and really conflicting evidence working in both directions. Where do you come down?
Yeah, so we're most likely in a bull market, even though we haven't made a technical definition of one. And I think we really need to think about it is that in the early phases of a recovery, say around year 2 or 3, it's not uncommon for there to be fears of a double dip because the U.S. economy is so large, so developed. You're not going to maintain the growth rates that you get coming out of the recession. And so those fears of a double dip cause the market to pull back. But because double dips are very rare, only one in the last 60 years, that was in 80-82, that bear market tends to be cut short. And that's pretty much what happened in 2022. We had a growth scare, we got a bear market, but it really fit that kind of non-recession bear scenario. And so what we could see from here, is a recovery that could last at least until later on in the year, and then we'll have to see if the recession risks really come to fruition and actually we get the recession going into next year.
And Ed, I know you're also focused on some of the maybe oddities or distinguishing characteristics of this cycle when it comes to the interplay between the markets, the economy, Fed, and things like that. And basically, if we don't get a recession in the next month or two, it would perhaps be the longest time between an S&P 500 peak and the onset of a recession that we've ever experienced. Is that right?
Yeah, so on average, the market peaks about 6 months before the start of a recession. There's been some variation around that, but the longest we've gone is about 17 months. And so if we peaked in January of 2022, once we get to mid-year, we would have blown past that record. And so what happened last year is the market went down in anticipation of a recession that just hasn't happened yet. And so we have this window because of the resilient economy for the market to rally. Maybe we just got a little ahead of ourselves in anticipating the recession that was supposed to start last year that just hasn't happened.
And Jeff, I guess whether or not we should be broadly concerned about the fact that it has been some poor breadth in this market, I guess it should instruct us how to play it. I mean, do you look for laggards, or is it about essentially, being selective about what's already outperforming?
Yeah, I mean, we haven't seen the extreme yet to get us to sort of flip. So we're still momentum players in that realm. But I do think things like semiconductors, as an example, We're seeing some corrections there, which are still in very good uptrends from our work. We're starting to see some emergence out of healthcare equipment names. Absolutely, at this part of the cycle, that's something that can work, as they tend to have a little bit more cyclicality within healthcare. So, we tend to stick with the winners, particularly in an early cycle. I would agree with Ed. We're in a bull market. It is not a table-pounding bull market. I actually think one of the ironies might be here that the bears will get emboldened by a recession, and even though we don't really see that happening here, let's say that we're wrong and we see that that comes to fruition sometime, maybe late in the summer. What's interesting is one of the things keeping a lid, in our view anyway, on the S&P is the relative attractiveness of what you're seeing in the bond market. And so a recession actually would end up pushing yields down, which therefore could actually give a bid to equities as that yield differential starts to make equities look a little bit more attractive. So bears might actually have it completely wrong, that the recession ends up being bullish for them versus bearish. So we'll see.